This is an Uncovered Japan Company research report on Smaregi, ticker 4431. Smaregi takes a humble but essential job running a shop's checkout and turns it into a cloud platform for sales, payments, staff, and stock. In the next few minutes, let's look at what customers actually use, how the numbers have scaled, and the questions that still matter. Here is the quick snapshot. By the third quarter of fiscal 2026, annual recurring revenue had reached 10.4 billion yen. That followed a 5-year ARR compound rate of about 38%. The other numbers are just as important. Monthly churn was only 0.48%, while fiscal 2025 operating margin reached 21.5%. Those figures point to a profitable subscription business, not simply a fast-growing software story. This is the product in one picture. At the counter, Smaregi is an iPad-based point-of-sale system that records a sale and manages inventory. But the business goes beyond the register. Paygate handles cashless payments. Timecard helps with attendance and shifts. And Smaregi EC connects online sales and stock. For a multi-store operator, having those systems share the same data can make everyday operations much simpler. The financial record is straightforward. Revenue rose from about 3.3 billion yen in fiscal 2021 to 11.1 billion in fiscal 2025, a 5-year compound rate of 35.1%. Operating profit also climbed, taking margin back above 20%. That combination matters because it suggests the subscription model has been scaling efficiently, even as Smaregi invested in new products and acquisitions. Smaregi's store base is also broader than a single retail theme. Retail is the largest group at 31% of monthly active stores, followed closely by restaurants at 28%. Cosmetics, apparel, beauty, medical and pharmacy customers add further diversification. That mix matters because it spreads demand across several types of physical businesses while keeping the product close to the day-to-day workflow at every checkout. Why might customers stay? The answer is integration. Smaregi is designed for the awkward middle of the market. Operators with several stores that need inventory, analytics, staff management, payments, and online stock to work together. Replacing one tool is manageable. Replacing the system that connects all of those workflows is harder. The report also notes that Paygate was attached to 56% of stores, while churn reached just 0.48% a month. Those are the operating signs to keep watching. The balance sheet has supported that growth rather than stretching for it. In fiscal 2025, the equity ratio was 71.8%, and return on equity was 21.4%. The report describes Smaregi as debt-free, with cash and operating cash flow available for product investment and selected acquisitions. High returns do not remove execution risk, but they do give management more room to make long-term decisions. Looking forward, Smaregi's Vision 2031 sets an ambition of 30 billion yen in annual recurring revenue versus 10.4 billion at fiscal 2026 third quarter. The important point is the path, not just the headline. The prior midterm plan targeted 9.46 billion yen of ARR by fiscal 2026, and the company had already exceeded that by the third quarter. The strategic question is whether it can keep expanding its store base and cross-selling more services into each customer. A balanced view also needs the risks in plain English. Recruit's free AirRegi is the main competitive pressure if it becomes stronger for multi-store operators. Smaregi also needs to integrate acquisitions well, and softer consumer spending could make retailers more cautious. Finally, insider ownership limits free float, which can affect liquidity and share price volatility. These are all measurable risks, and they are more useful to watch than a vague warning label. Valuation is where the report finds the sharpest contrast. It puts Smaregi at a forward price-to-earnings ratio of 22.9 times versus a roughly 45 times 5-year historical median. That does not automatically make a share cheap, especially in a volatile software sector. But the report's point is that the multiple compressed while the underlying business continued to grow earnings. Future execution and the market's willingness to value SaaS growth remain the variables to watch. This final chart is best read as a framework, not a forecast. The report's bear, base, and bull cases vary 3 inputs: recurring revenue growth, operating margin, and the valuation multiple. That is a useful reminder that strong operations alone do not determine an investor's outcome. For Smaregi, the recurring revenue path, churn, payment adoption, new store growth, and competitive pressure will all matter more than any single scenario number. To wrap up, Smaregi is a Japanese cloud POS company built around a sticky, multi-product operating system for stores. The evidence in this report is strong recurring revenue growth, low churn, healthy margins, and a solid balance sheet. The open questions are equally clear: competition, execution on the long-term plan, acquisition discipline, and valuation. For the full evidence, charts, and assumptions behind this overview, the deep dives on Uncovered Japan take the story much further. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.